Hello fellow bodegans. Welcome to the second video of what will be a handful of videos to which you can refer back to as a trading resource. As always, you hereby agree to not make any actual trades nor trading related decisions based on the information presented herein. All information is for educational use only. No advice nor recommendations for what to buy, sell, nor hold are being provided. Let's begin. As a trader, risk management is the most important factor in successful trading. It is what allows you to stay in the game long term. I'm one who has learned this the hard way. Early on, I blew out some small accounts thinking that hitting for the fences was the only way I could make large profits fairly quickly. It is not. In fact, that approach was nothing but gambling. It was not until I understood position sizing and managing my trades did I begin to make risk-adjusted profits. What is position sizing, and how do I manage my trades? Let me show you. Here is a sample of my trading journal. Similar trading journals are available online for free, or you can simply create one in Excel or any spreadsheet. There are some formulas with which you will need to be familiar, such as return on investment calculations. The math for the most part is pretty straightforward. If you do not currently have a trading journal, you cannot accurately review and analyze your trades. If you are not doing so, you cannot improve. You should be able to refer back to your trades to figure out where a trade may have gone wrong or how you can do even better next time. Certain trends will be revealed in your journal trades. For example, where do you typically take a trade? Is it at a breakout, a gap up, or some candlestick formation that you prefer? Are you using the correct position sizing, or are you taking on too much risk? Those are questions that you need to answer. Are you correctly adjusting your stop loss as the trend moves favorably? This analysis will help you improve as a trader. Position sizing is nothing more than calculating the number of shares that you can trade given your risk tolerance and your stop loss. I'm going to input several different portfolio values into this journal to show you how the numbers work for different portfolio sizes. However, percentage-wise, these values make no difference. I've also included random values for ROI. They range from 10% down 10% to up 20%. My risk-reward ratio is always at least 1 to 2. For every dollar I put at risk, I want the potential to make at least $2, or I will likely not take the trade. Will you always make $2? The better question is, should I always wait for the $2? The answer is no. You manage the trade along the way. At some level before your target, you may have to take a profit, perhaps between $1 and $2. Sometimes you underestimate a trade and it turns out to be greater than a $2 reward. You will never consistently catch the peak, but if you are correctly adjusting your stop loss and taking profits as the trade moves favorably, you will earn positive risk-adjusted returns in the long term. So whether I have $2 million or $2,500, okay, or even $25,000, okay, your portfolio size does not matter for purposes of this illustration, right? So, you want to know your risk tolerance, okay, whether that be 1% or 3% of total portfolio value, or you want to do 5% on each trade or 10% on each trade. I rarely go beyond those amounts. However, I did want to show you that certain traders will be far more aggressive, and they will, based on their maximum risk tolerance on a portfolio, let's say they have a $2 million portfolio, and they want to go aggressive. They're in it for maybe like 30 minutes, an hour trade. I wouldn't do it overnight because there's a gap risk associated with doing something like this. Um, you don't want to wake up the next day and the stock's gap down below your stop loss. So some traders will say, okay, well, I'm willing to take a $20,000 loss, 1% of my maximum portfolio. I got a stop loss at about $2.75 based on an entry of $66.73, and support is at $63.98, or 30% or 30 cents higher than that. I typically will put my stop loss anywhere from 10 to 30 cents below the support, just to avoid any hunters out there, stop loss hunters out there, right? So someone who's aggressive might say, well, I'm willing to put 24% of my portfolio into this trade just for like 30 minutes, an hour, probably even better 15 minutes or less, just to make whatever my target is on the trade, whether if I have a stop loss of 275, maybe I'm looking at 550 as my target, right? So 550 or $7-8, right? So you might want to put that in, and then see if you can hit your target, adjusting your stop loss along the way, trailing it so that should the stock turn against you, you can get out as quickly as possible. So yes, that may make sense to an aggressive trader with a lot of money. My feeling is it's not worth the risk. If the stock gets halted and then reopens at a much lower price, there goes a huge chunk of your portfolio. So I like to mitigate my risk by keeping my entry amounts to 5%, 7%, 3%, 4%. You'll find that institutions will typically initiate positions of less than 5%. They'll start off small, add to it. At some level, in fact, I think hedge funds have to report if they're greater than a certain amount in a particular company, if they own a certain amount in a particular company. But in any case, I wanted to show you, well, first let's hide this. Let me explain this. This is a way that I calculate how many SPY put spreads that I need to buy in the event of a drawdown in the portfolio. So markets falling, and I need to hedge my portfolio. I will typically use the SPYs to mitigate my risk, but it's a little bit more complex than what I wanted to show you today, because you have to know what the beta of each of your holdings are and to the SPY, and you have to correctly weight that so that you can figure out how much protection you need. So a little bit complicated for purposes of this video. We're going to hide, go ahead and hide these rows. Suffice to say, this is just another technique that I use to mitigate my risk, especially during a period of drawdowns in the market. All right, so I put together the sample trading journal. I like to, on my trades, put the reason why I'm getting into the trade, whether it's a gap up, bounce off support, entry level, first target, second target, with the risk reward ratios calculated in there. Okay, so these are all formulas. These are and then you know your entry price and your stop loss and the number of shares, and you can kind of do a percent from target and our percent return on investment, or percent return given the current price of the stock. All right, so below that, I wanted to simulate an account that had a certain number, a certain win rate, and a certain number of trades. So I can do 10 trades. Those numbers automatically change. Their formulas. Um, uh, in my previous career, I must have been a computer scientist. I love to like code a bit. So, but I digress. Anyway, um, so I've put together this just to kind of show you how a portfolio with a 50% win rate or even lower. Let's see if we could get a lower win rate on this. Let's go 40%. Come on. These are all random, so that's why just have. Oh, I just had it. 30%. Ah, come on. Gone too fast, maybe. All right. Anyway. Okay. Anyway, I wanted to show you how the return on those trades, even with a losing win rate, or a low win rate, you can still mitigate your risk and even make money. See if I can. There we go, 40% win rate. Okay, so even with a 40% win rate, you're not losing a whole lot of money on this portfolio. You've managed after 15 trades to only lose 145, 1.45%. All right. So I wanted to show you that as a kind of proof or a way of showing you how even if you're a horrible stock picker, you can still mitigate your risks and keep going to play the game another day, right? And I learned early on you don't need 80% or 70% win rate to make money in this market. I mean, you could think of these returns as annual returns, monthly returns. I mean, if you're trading 15 stocks a month and you're getting 6.31%, that's a very respectable return on your portfolio. So let's see. So again, you want to think of these in terms of either monthly or annually. 6% annually is respectable. I think people will typically want to do anywhere from 7 to 10% annually and compound that, right? Obviously the market's been doing far much better than that on average, but you get my point. So if you, let's see. But if you're trading without a journal, there's no way for you to understand how you can improve or what you've done wrong in the past. You really have to trade with one. I really plead with you to do so. It will dramatically improve your understanding of what you're doing and how you can trade better. So again, you can do this exercise on your own. I basically you can input these numbers. You don't have to put in formulas, but just understand that they're random because I wanted to show both losses and positive returns, so you can see the outcome. So having said that, this ends my this week's video, an explanation of the importance of having a trading journal. I want to wish you all the best of trading this week, and until next time, I bid you farewell. All right, fellow bodegans, good luck trading.